To save or to invest? A fairly crucial question that has a dramatic impact on your overall long-term wealth. It's tempting in times of trouble when you're expecting volatility in the markets to stay in cash. Cash is safe after all, isn't it? Well, I'm going to argue that no, it isn't. Cash is eroded by a silent enemy, inflation. And to build serious long-term wealth, you've got to think about moving out of cash and investing. So let's start with a quote, one of my favourites. How many millionaires do you know who've become wealthy by investing in savings accounts? I rest my case. Now, some of you might be thinking, well, whoever that is, they're talking about millionaires. What's that got to do with me? Well, the answer is, it's got a lot to do with a lot of people. More of us need to be millionaires than you might first think. Here's why. First of all, we're all going to live longer than many people think they will. Lifespans are increasing. So a 40-year-old alive today could be looking to live until their 90s and may not be retiring, that's the bad news, until 70, perhaps even older. So that's plenty of time ahead, even if you've hit what's classically known as middle age. You've still got plenty of years where you should be investing and should be trying to build wealth. As for how much, right, well, this is a fairly scary statistic. A 65-year-old retiring now, wanting an income of around 40,000 index linked, that means 40,000 that will rise with inflation in some way, needs a pot, and there it is, of around £1 million. So they need to be a millionaire. And that just goes to show that millionaires are going to have to be more common than perhaps a lot of people realise in the future. Now, how are we going to get there? Cash is a great asset in some respects. It's a useful way of getting things done, but there its usefulness stops. All right, so reasons we have cash. All right, it's liquid, portable, divisible, and that makes it a great medium of exchange. In short, to translate the economist jargon there, you can pay for things with it easily and quickly. Brilliant, we don't do bartering anymore, we have cash. Beyond that, it is something you can put some of your wealth into. All right, it is relatively price stable. It pays an income, albeit not a very big one, and it has what I've grandly called optionality, the ability to pounce on other assets when they're cheap. But the mistake is to view cash as something else that you'll find in the textbooks, and that is a safe store of value because of inflation. And inflation does terrible damage to cash, and it does it kind of silently. It creeps up on you. Now let's take a look at that. Let's take £10,000 invested over 10 years at different rates of inflation. Lowish, 3%, not a million miles away from where we are today in the UK. A longer term average of around 5%, that since the 1950s is more typical of the UK. 8 and 10% we haven't seen recently, certainly in the UK economy, but not impossible. There have been periods in the past where inflation's gone to those kinds of levels. And what sort of damage would that do to a pot of £10,000 sat under the mattress, if you like, over 10 years? Or in a bank account where you're pulling out the interest and spending it? Well, here's the answer, okay? 3% inflation, only 3% inflation will reduce that pot to below £8,000 over 10 years. So you haven't done anything. What that means is, in real terms, you're losing money. That pot buys less after 10 years, even at just a 3% rate of inflation, which sounds pretty harmless, than it would have done at the start of the 10-year period. 5%, the damage increases. Now you've got just over £6,000 in sort of real spending power terms. Now, what I mean by that is the £10,000 will look the same when you pull it out from under the mattress. But to your horror, you'll find you can't buy as much with it. 8% does even more damage, and at 10% inflation, okay, you're looking at below £4,000 in real purchasing power terms. And that's over a relatively short period. We'll expand that out in just a minute. Now, a lot of people don't worry about inflation. They say, well, today's inflation rate is nice and low, so who cares? Well, here's your problem. Inflation may be low today, but you're still losing money sitting in cash. You know, most bank accounts are paying 2% or less. That's an interest rate. Tax will knock off 40% of that as a higher rate taxpayer. And inflation, even hovering at 2.5 or 3%, is therefore eroding each month, each day, each year that passes the return you're making. And that's why Barclays, in their equity gilt study, their influential report, predict that most people sitting in cash will make a negative real return, that's after inflation, of 1.5% a year. Put it another way, you are losing 1.5% a year by staying in cash, and you probably won't even notice. And the damage gets really serious if you look over much longer periods. Let's take a look at a pound over 25 years, all right, at 3 different rates of inflation. Let's take a really low one, 2%, all right, that's a bank target, or has been for some time, 5% and 10%. And here's the damage over 25 years rather than just 10 or 5, all right, 2% inflation, just 2% reduces a pound to around 60p. At 5%, the UK's long-term rate, okay, you can see even more damage is done to that pound in terms of what it will buy. It'll still look like a pound, but what it will buy is reduced. And 10% really, really hammers the spending power of that original £1, reduces it to a few pence. So, what does that mean? What should you do? Okay, here's the answer. Let's take a look at some real returns. That's after inflation's been taken into account over a 10-year period, 2002 to 2012. All right. Now, here's what cash looks like. Did you see that move? Cash offers a negative 0.2% return between 2002 and 2012, according to the Barclays Equity Gilt Study. So you're losing money all the time in cash, but not realising it. Now, it's interesting just to compare that to a couple of other assets that perhaps you could have been in. Equities have offered, according to Barclays, a reasonably consistent average return. They stress that word average of around 5%. They are taking more risk, but that's a significantly higher annual return. And government IOUs have managed 3.4% positive over that 10-year period. So my point is that cash both costs you in real terms, and there are other places you can think about making better long-term real returns. Now you might say, I've just chosen that 10-year period to make my point, so let's widen it out a lot. The same study points to £100 invested in 1899 and says, basically, what would that look like today, strictly speaking in 2012, okay, if you were to take income and inflation into account, all right? So in other words, what would your real return be from holding £100 in these 3 different asset classes over a massively long period, much longer than I've looked at before? Now you might say it's a bit extreme, but it will make my point. Cash barely moves. Cash would be worth £267, all right? Equities, 24,184. Now what's going on there? Well, it's the fact, in part, that equities are generating decent income, higher income on average typically than cash balances. You're also getting some growth in there. So equities would generate a sum of more like 24,184 after inflation, and government IOUs struggling a bit over the longer term, just 434. Okay, so making a fairly clear message over the longer term that there is definitely a better home for your money potentially than cash. Now, conclusion. If you're thinking I'm writing off cash, I'm not. As a short-term rainy day fund, somewhere to keep money that you might need if you're made unemployed, you become sick, or you need to fund something short-term, you need some cash. Everybody needs some cash, but don't overdo it. All right, it won't fund big expenses. You're not going to retire by keeping your money in cash. That's because it's losing value in real, after inflation terms every year, even if you can't see that happening. And therefore, anyone who says cash is risk-free or a risk-free asset, I don't think is giving you the full picture. To make serious wealth long-term, you've got to take a bit of risk and move out of cash. Okay? Where would you move to? Well, this will be the subject of other videos primarily, but I'm going to suggest there are 3 places that most investors will keep some of their wealth. Cash and things like cash. And in there I put fixed income securities, company and government IOUs. More about those in future videos. Property. Most people own a home, and there are good reasons to own a home, and for a lot of people that takes care of their property allocation. There are pitfalls moving into sort of buy to let and so on. I'll cover those in another video. And finally, as we've seen briefly here, equities. Potentially a good long-term home for a substantial proportion of your wealth. So in summary, cash has its uses, but don't stay in it for too long.